Hello everyone, welcome back to our channel Trading Critique. Ever wondered how those Forex traders make all that money? It's not magic, trust me. It all boils down to understanding a few key terms. Today, we're diving into the world of Forex for absolute beginners. We'll break down 4 essential concepts: bid price, ask price, spread, and commissions. Don't worry if these terms sound like alien language right now, because by the end of this video, you'll be speaking Forex fluently. Bid price and ask price. Let's start with a simple analogy. Imagine you want to sell your car. You'd probably have a price in mind, right? That's your asking price. Now, potential buyers will offer different amounts. The highest offer you get is the bid price. In Forex, it's similar. The bid price is the price at which a market maker or dealer is willing to buy a currency pair from you. Let's say you want to sell euros for US dollars. The best price someone is offering to buy your euros is the bid price. Someone is offering to buy your euros is the bid price. On the other hand, the ask price is the price at which you can buy a currency pair. It's like you're the buyer this time. So, if you want to buy euros with US dollars, the price you'll pay is the ask price. As you can see, the ask price is always slightly higher than the bid price. That difference is crucial and we'll talk about it in a moment. Remember that tiny gap between the bid and ask price? That's called the spread. It's essentially the cost of doing business in Forex. Traders aim to minimize this spread because it directly impacts their profits. Let's say you want to buy euros. The bid price is 1.1200, and the ask price is 1.1202. So, you'll have to pay 1.1202 to buy €1. But when you sell it back, you'll only get 1.1200. That 0.0002 difference is the spread. It might seem small, but it can add up, especially for larger trades. That's why many traders look for brokers with tight spreads. The smaller the spread, the more profit potential. Alright, so we've covered the spread. But there's one more cost you might encounter: commissions. Some brokers charge a fee, or commission, for every trade you make. It's like paying a service charge for executing your order. Now, you might wonder, why would I pay a commission when I'm already paying the spread? Well, some brokers offer very tight spreads but make their money through commissions. These are often called commission-based brokers. Let's quickly recap. The spread is the difference between the buy and sell price of a currency pair, while commissions are fees charged by some brokers for executing trades. So there you have it. Understanding bid price, ask price, spread, and commissions is the foundation of Forex trading. These terms might seem a bit overwhelming at first, but with practice, you'll get the hang of it. If you found this video helpful, be sure to hit that like button and subscribe to our channel, Trading Critique, for more Forex tips and tutorials. Thanks for watching, and happy trading!